Hey guys, back with another video. So this is about chapter 10, non-monetary exchange. This is the formula. This is the video about the formula. So what I'm going to do here is I'm just going to walk through this formula, and then what we're going to do is that we're going to kind of dissect every part of it except for the fair market value of other property given up and received. We're not going to look at those, mainly because that just kind of complicates it a little bit more than we're going to do in this class. These are here, they're correct, but they're here mainly for completeness purposes, okay? So the reason that I'm using this formula is just so that way people have multiple ways of solving the same problem. This video, we're doing the formula and kind of the rationale for the formula, and then in some other videos, we'll do actual problems applying the formula, and then walking through the actual numbers of how it would work, okay? So basically what I'm gonna say at this point is I'm going to have a link to this in the description, the actual formula sheet, and this video might get a little long just because it's going to go into conceptual and theoretical stuff. I definitely recommend watching it, and I definitely recommend learning it. This is a very useful way of learning this, and I truthfully think it's the best way. It takes some time to understand, and so it's a little challenging, and so that's why what I'm trying to say is it might not be for everyone. If you feel best just memorizing this, that's up to you. But I'm going to go ahead and go through the actual rationale of why you're doing these things, just in case if you were to forget on exam day, you could recreate the formula in your head by just understanding what's going on. And I've taught people this using this method in the past, and it seems to have good results. Okay, so the way that we're going to look at this formula is through a tax perspective. Okay, a lot of you guys, obviously none of you have taken any tax classes yet, but this formula, the one here, it's literally from the tax code, from the Internal Revenue Code, and these relationships work the same for financial statement purposes for FAR 1 as they do for tax. But the rationale is clearer. It's more easy to see when you look at it from a tax perspective. Okay, so we're going to go through it from a tax perspective, but then we can just easily apply that back to the financial statement perspective. Okay. The first thing we're going to say that we're going to note is we have the net book value of the old property, okay? I'm going to use a term called basis a lot, okay? Basis is a tax term. It means net book value, okay? So net book value is what? Original cost minus accumulated depreciation. So net book value and basis are basically interchangeable, okay? A basis or adjusted basis, more or less the same thing. But yeah, if I say basis or adjusted basis, I mean net book value. It's a tax term for the financial statement equivalent, which is net book value. Okay, then we add our gains that we recognize. And note, it's not all gains, it's only gains that are recognized, right? So as we reviewed in the last, the first video, and as we'll see as we move forward, we don't recognize all gains. We're only going to recognize certain gains and in certain situations, right? So if we don't recognize the gain, we do not add it. We add any cash that we pay. We're skipping this one. We subtract any losses that we recognize. In this one, we would always recognize the loss, so we're always going to subtract it. And then finally, we subtract any cash that we receive. And again, we're ignoring that one just for simplicity's sake. And then the net book value, and then that gives us the net book value of our new property. Okay, so we start at the net book value of our old property, and what we're trying to do, the hardest part of these problems is to find the net book value of the new property. Okay, and just for anybody that has questions about these, I'll cover them very quickly, just so we can clear it up. When it says this other property, what I mean by that is, like, let's say you were trading in a truck, and then let's say for a truck, and then you also threw in a boat or something. Okay, that would be determined to be other property. Property other than the property that is the main part of the transaction. Okay, the main component of the transaction, any other property would be determined to be other property. All right, so that's the first part. Okay, so let's just go through basically these two and then these two, why they make sense. All right, and to do that, the way I'm going to walk through this is I'm going to talk about what is this idea of basis or net book value. Okay, basically what happens is that when we buy an asset, what do we generally do? We generally will pay cash for that asset, right? And so what happens is that over time, the government, and we're looking at this from a tax perspective, so we're going to look at it from the government or the IRS's perspective. Okay, what does the government allow you to do? You're allowed to take depreciation deductions. Okay, that is the same thing as taking depreciation expense. All right, and so when you take these depreciation deductions or you take depreciation expense, what does that do? that lowers your taxable income. Okay, it lowers your taxable income or your net income. It lowers both of them, right? And so why is that good? That would be good because then we would pay less tax, right? So we take these depreciation deductions or we take depreciation expense, it lowers our taxable income. That means we're going to pay less tax, okay? So that means that all things equal, we want more of this. We want more basis. We want more net book value, right? Because what that is going to allow us to do is to lower our taxable income, right? So if we had, just to see that very quickly, if we had a basis of 50 or we had a basis of 100, right? If we had income of $100 before these depreciation deductions, before we took depreciation expense, in the one scenario, in the first one, we would have $50 of taxable income. We actually would have to pay tax. And the second one, we would pay no tax, right? Because we would say $100 of income, $100 of expense, zero taxable income, zero tax. Okay, so all things equal, if we want more basis, we want to have more net book value. Okay, and so what happens is that there's a couple of ways to get this basis, okay? In the tax world and in the financial statement world, there's two ways to acquire basis, okay? And they're shown in this formula. So the two ways to increase basis. Basically, we have recognize taxable income, which is going to be the gain. Okay, that's the first one. I'm mapping these, so that's one and that's two. Okay. And the second one is to pay cash. All right. And so we'll walk through these and we'll discuss why that makes sense. All right. So the first one. Okay. What happens here is that, so again, what happens is that when we have our basis, we're taking depreciation deductions. We have to keep that in mind. Okay. We're reducing taxable income, right? So what happens here is, let's say that we have a gain. Okay. Let's say we sell a piece of equipment and the government requires us to pay tax. Okay, so let's say we have some piece of equipment and we end up recognizing a $50 gain on it. Okay, what the government is going to say is, okay, you have $50 of money, you got $50 of gain from that thing, we need you to pay tax. Okay, we want you to pay tax on that, right? Because if you get money, if you've worked at a job, you understand that if you make money, the government taxes that, right? You can't just get a gain, or you can't just make money and not pay tax. So you have this gain, so you end up paying tax. But the flip side of that, the good side of it, is that it increases our basis. It increases the net book value. Okay, so what happens is that, let's say this is year one. Okay, year one, we have $50 of gain, and we pay tax. But the positive is that it increases our basis. Okay, and why is that positive? Because we have to remember back here, we can take depreciation. I'll just write expense this time, but again, it's expense or deduction. We can take depreciation expense, we can take depreciation deduction, which is going to lower our taxable income, right? So then in year two, we can take the $50 of depreciation deduction, and what's that going to do? That is going to lower taxable income. Okay, so it's going to lower our taxable income. So what I'm trying to demonstrate here is that whenever you end up paying tax on these gains, it increases your basis, right? So we're not totally at a loss, because what happens is, yes, we have to pay tax on this income. We have to pay tax on this $50 of gain, but then we get to deduct $50 later on, okay? And so it's basically an even-handed exchange. Other than the time value of money, we're exactly the same off as we would be, because what happens is we pay $50, we pay tax on $50, and then we subtract $50, right? So if we ignore time value of money, right, year one, we pay maybe, if it's 10% tax, we would pay $5 of tax, but then we would save $5 in tax in year two. And so that decreases our taxable income in year two, and so it basically balances out. Okay, so we end up increasing basis. That's the reason you get to increase your basis, is that's the government's way of saying, okay, you paid tax, so you get to have sort of this trade-off. You pay tax, but then you get to recover it in the future. Okay, that's the whole point of depreciation. Depreciation is supposed to lower your taxable income, and it's supposed to provide you a recovery of capital. Okay, because if you pay cash, then that means you should be able to recover that cash through depreciation deductions, through lowering your taxable income. That's how the government incentivizes businesses to stay in business. by basically saying, okay, if you buy this asset, you can lower your income by the amount, you can lower your income through these depreciation deductions by the amount that you paid in cash or the amount that you recognize as taxable income. Okay, and then the second one is very easy to see, right? We know this all the time. If we pay, $50 for an asset, then that means that our basis in the asset or our book value in the asset is what? It's $50, right? So that one's super easy to see. All the government is doing there is recognizing, okay, you're paying cash. As I just kind of went over that, but you're paying cash. So the only way to incentivize business, or one way to incentivize businesses, is to say, if you make this initial investment up front at $50, then we'll let you subtract that away from your taxable income and lower your taxable income, so that way you pay less tax, right? So it's basically a recovery of capital principle. That's what is going on there. Okay, so that's the first part of it. That's these first 2 points here. Then we just have these last two to go over, and then basically we'll have gone through this topic. And then what I'm going to do is that once we've developed this formula completely, we're going to, in other videos, we're going to use it to solve problems, so that way you have an extra way of checking your work. All right, so finally we have loss recognized and then cash received. Okay, so these are two ways that are going to decrease your basis, and they make sense, right? So in this case, they're literally the exact opposite. We recognize a loss, or we receive money or cash. Okay. And so these are literally the reverse of what we have up top, right? So we increase our basis by recognizing a gain. Well, we decrease basis by recognizing a loss. We increase basis by paying cash. Well, we decrease basis by receiving cash. Okay. So let's just go over these, the rationale for these very quickly. So the first one, recognizing a loss. Okay. So what happens there is that, let's say, as we said before, we want more basis, right? Because if we have more basis, then we will be able to take these depreciation deductions. The other reason we want more basis is because we're more likely to recognize a loss. All right, so what does that mean? All right, let's make an example. Here we have an example, okay? Let's say that the basis or the book value of our asset was, say, $60, okay? Then, and this is within the context of a non-monetary exchange. Okay, let's say that the fair value was only 50, right? We would clearly see there that our loss is 10, right? Because the basis is more than the fair value by $10. The book value exceeds fair value by 10. So we have this loss. What happens when we recognize this? What happens when we do the non-monetary exchange is that we're always going to recognize this loss, right? And so what ends up happening there is we have a loss, okay? And what is a loss going to do to our taxable income? Well, a loss is going to decrease taxable income. Okay, a loss will decrease taxable income, right? Because what we're doing is we're saying, okay, well, we had $100 of income, and then we subtracted 10 of loss. Well, we only have 90 left, because the government will allow you to deduct the. Let me just shift the camera here, guys. 1 second. Sorry about that. So what the government will allow you to do is, if you have a loss, you can subtract it and you can reduce your taxable income, okay? But the government does not want you to double count your losses, okay? And so what they make you do is that they make you subtract out any loss that you've recognized here at the very top. And so what happens is that you lose that ability. When you subtract out this loss, what happens is you lose the ability to take a depreciation deduction, right? So in this example here, right, as we said before, more basis is better because it allows us to reduce our income, okay? And so what happens in this example is we initially have $60 of basis, right? And so theoretically, in that case, we'd be able to take $60 of depreciation deductions and lower taxable income by $60, right? But we already take 10 here, right? So then it wouldn't be fair for them to take another 60, right? It's only fair that we take 50 at that point, because the government is allowing us to take the 10 now when we recognize the loss. We should only be able to take 50 in the future, okay? And so the way to do that is to reduce the basis of the asset that we're putting on the books, the new asset that we're putting on the books, all right? So we're still going to take $60 of deductions, or we're going to subtract out $60 total. It's just going to be 10 here and then 50 here, right? Because if you thought about it, if we subtract 10 here and then we still take the basis at 60, if we don't adjust the basis, then we would basically get to count that loss twice, right? Because we would get 10 here, and we would still get 60. That means we would end up with 70 of deductions in total, but we should only get 60. Okay, and so that's why the government allows us, they allow us to subtract out the loss, but then we have to reduce our basis. It's the exact opposite of the gain, right? The gain, you pay tax, but you get to increase basis, which is good because we take depreciation deductions. Under the loss scenario, we get to take the loss, which is good because it reduces our taxable income, but then we have to reduce our basis, which is bad because then we can't take depreciation expense or deductions. The final part is cash received. This one is relatively easy to see as well. Right here, I'm going to write, basically what's happening is that you're swapping basis for basis. Okay, you're basically what's called is you're cashing out of your investment. Okay, and so what happens here is that, let's say that in this case, you have an asset that has, let's do a new example. Let's say you have an asset with a basis or a book value of $70. Okay, and then let's say somebody gives you cash equal to 10, and then another asset. Okay, they give you another asset, and the actual value of the asset is not super important here. We're only focused on, we'll just assume that 0 gain or loss. That's what we're going to assume here. We're going to assume we have no gain or loss just to isolate this one characteristic or this one variable of receiving cash or money. All right, so what happens is then you start off with an asset with $70 of basis, right? And then on the other side of the transaction, you're getting something worth 10, cash of 10, which means your other asset, the basis, should only be $60, okay? And that makes sense because cash, the basis of cash is just the actual worth of cash, which is $10 in this case. Sorry, this says 60 down here. Might be a little blurry. So what happens is that cash, the basis is 10, and then this other asset, the basis is 60. So you can see 10 plus 60 equals 70. We can't end up with more basis in this other asset, okay, than we started out with plus the cash received. So that's why I'm saying we're swapping basis for basis, or we're cashing out, okay? We're swapping part of the old basis for cash, and then we're taking the remaining amount as basis in this new asset, okay, right? So if we looked at our formula, it says you start off with, so if at the formula you would start off with the old book value, okay, you would subtract out the cash received, and then you end up with new book value, okay? And that makes sense because you don't want to double count the basis, okay? And so basically that's how all these things work. That's how they all interplay. I know that's a long video. I know there's a lot there. You might need to watch it more than once, or you might just decide to memorize the formula at this point. But if any of you guys end up doing tax, this will be helpful in the future. And so I just wanted to put it out there because I think this is an extra way of knowing how to do it. And this is a good explanation of kind of the logic behind it and what's going on, and it gives you a way to check your work. So I hope that helped, and I'll see you in the next video.